Hey, this is Mike Hambright with Flip Nerd. Welcome back for another Flip Nerd VIP interview show. Today I have with me Keith Borg of the Borg firm. He's a CPA. He invests in real estate himself, and he's going to tell us a lot about the importance of having a good accountant and a good tax strategist. And we're going to talk about some of the tax laws that are impacting real estate investors right now and things that are happening in the future. Before we get started, though, let's take a second to recognize our featured sponsors. RealtyMogul.com is an online marketplace for real estate investing, connecting borrowers and capital from accredited and institutional investors. Get a rehab loan fast and close in as little as 10 days. Rates start as low as 9%. We'd also like to thank National Real Estate Insurance Group, the nation's leading provider of insurance to the residential real estate investor market. From individual properties to large-scale investors, National Real Estate Insurance Group is ready to serve you. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of FlipNerd.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing can be risky. So Keith, welcome to the show.
Hello, good morning.
How are you doing?
Doing well. How about yourself?
Awesome. Well, thanks for joining us today. I've been, in fact, we have some mutual friends. We haven't met each other before, and I'm excited to have somebody on the show to talk about some real important issues that a lot of folks, certainly veteran folks, understand the importance of having a good partner from a tax planning and strategy standpoint, and obviously a good accountant. So glad you're here.
Thank you. Glad to be here.
Awesome. Well, why don't you go ahead and introduce yourself? Tell us a little bit about your background and not just as a CPA, but also as a real estate investor.
Sure. So I've been doing tax returns since 2006. My name is Keith Borg, obviously, and I'm with the Borg firm, PLLC. So I own a local CPA firm here in Dallas, Texas. I'm beyond just being a CPA. I'm also an active real estate investor. I first started buying houses in 2010 after I started seeing how great the market was, realized I did not want to put my own investments into stocks, bonds, mutual funds, that sort of thing. So I wanted to be a little more hands-on with my investment dollars. So with that, I've since gone on to own 9 rental properties. I also own some owner finance notes, and then my better half runs our flipping and wholesale business.
Okay. And you tell us a little bit more about your background. Did you start with Deloitte? I know you spent some time with Deloitte.
Yes. So I started my career in Deloitte, actually in San Francisco. I'm originally from California. And then I moved here to be here. I moved here for a girl who's originally from Dallas, Texas. And so I moved here and I went on to work for another local CPA firm here for a while, which is where I really got hands-on with a few investors. What really opened my eyes is I had a client that had 60-something paid-off rental houses on his own, and he had retired himself by the age of 40. So that's what really opened my eyes to start getting invested in real estate myself.
Okay. And to kind of go out on your own from the entrepreneur side of this, to start your own law or your own accounting practice, what kind of hit you that when you were working with somebody else that you weren't getting there that you thought you could on your own?
Well, on my own, one, I like the control, the time, the flexibility. What they say is it's the entrepreneur that will work 80 hours a week to avoid 40 hours a week for somebody else.
Yeah.
So I really do enjoy it. It's some long hours during tax season, but I really don't mind it because I know over the summer I'm going to be taking more vacation time than I would otherwise do, and I will also be able to, I guess, have the time be where I need to be when I need to be there.
Yep, that's awesome. Yeah, I definitely agree with the work hard, play hard mentality. I mean, we try to travel a lot, and what folks don't realize is I'm also working 7 days a week in some capacity. So,
yes.
And even when I vacation, unfortunately, I'm still working. But why don't you tell us your take a little bit on the difference between, we talked about this a little bit before we started the show, the difference between a typical accountant, somebody that can do your books and prepare you for, prepare your taxes and things like that, and an actual tax strategist, because it seems for a lot of newer folks probably think they're one and the same. having been in this business for a while, I know that they're very different in terms of somebody that can help me with tax strategies, things of understanding what types of legal entities to set up or how to kind of minimize your tax bill and be very strategic about things.
So a traditional tax preparer is somebody you take your tax data to at the end of the year, somewhere probably in March or April. You give them all your stuff. They look through it, they dig through it, and then they hand you back a tax return a couple weeks later or maybe much later. And there is very little collaboration in terms of what your own personal goals are or what you're doing. Most tax preparers are just simply trying to maximize your tax savings after the fact. A tax strategist is more of a tax partnership where you are working with your CPA throughout the year as any sort of big financial decisions come up, where you're able to call that CPA and they are able to help guide you through what your options are so you can help maximize your savings.
Okay. Okay.
So in some cases, your goal is not always to just simply maximize your tax savings like most people do. For other folks, it may be that you want to qualify for loans. So maybe you decide to not take all your tax deductions legally because you're not required to take all your tax deductions so that you can show a little higher income. And so it may be more important that you qualify for an additional 3 or 4 loans or more that next year, then you get an extra $1,000 off your taxes.
Right, right. Yeah, and I think it starts to bring in an element, too, of long-term kind of financial planning as well, because there's definitely some things that at least my wife and I do from a tax planning standpoint that it used to be, I guess early on, we were very transactional. We're worried about that year, and now we think much more about minimizing our tax bill for the long haul over long periods of time or until retirement or things like that.
So with me, I like to sit down with folks just like you or your wife, get an understanding of what your personal goals are, your real estate goals, and kind of talk through how we can merge that with tax strategy for the coming year and what really makes sense for you guys personally. I don't believe in a one-size-fits-all strategy.
Oh, sure, yeah. And what's your take on, I talk about this a lot. My wife is our CFO in our business, our investing business, and so we regularly talk about how, I will say they're not generally happy conversations, but how much time we spend figuring out how much we owe somebody else, which is the tax man usually. So it seems like it's good for accountants and tax planners, but for individual entrepreneurs, it really is a shame how much time we spend and how complex the tax code is.
Yeah, there is. We all have our specialties. People will specialize and have a career in different parts of business. So my focus has been real estate taxation. So this is going to sound kind of lame, but I really do read at least, I always have one book going at a time about either real estate investment strategy or some sort of tax strategy. Mm-hmm. It sounds boring for others, but for me that I spend my entire career doing this, that's my goal. I can never stop learning. I'm always learning something new. So as soon as I hear something that I'm not familiar with, I'm going out researching it in the tax code and figuring out the best way to take advantage of the tax code. As much as everybody thinks it may be black and white with 80,000 pages of tax code out there, bet things are bound to conflict sometimes. And trying to go through that mud it can be quite a task sometimes.
Yeah. And not necessarily your style. I'm not sure exactly what that is, but I've worked with different accountants and tax planners and things like that over time, that there are definitely people that their mentality is on one spectrum or the other. I want to do whatever I can to make sure we're never audited, or if I'm audited, this is how I'm going to respond to that question, because it's such a gray area that I'm going to take it to the line. I'm not going to take it over the line, but I'm going to take it to the line every time. Now, by nature, I think that more accountants tend to be very conservative in nature. But some tips that I've gotten in the past are, you want generally, and again, I don't know your background in terms of that, but you generally want people that are not afraid to be audited, because if not, they're probably leaving your money on the table somewhere. So any thoughts on the kind of differences between accountants?
So for me, I will match my investment, my tax preparation style with the investor or with the client. So I will get a feel for what their tolerance is for that risk, and we'll go from there. Because I've got some clients, for example, this last year I had a couple who made about $180,000, gave $70,000 to their church. So they knew that if they deducted $70,000, it could be an audit flag. So they decided they only wanted to deduct $10,000. I, however, had seen the documentation, had seen the letter, had seen the canceled checks to the church. So I knew without a doubt that they had truly given $70,000 to their church. So if it were me personally, I'd go ahead and take that deduction. And then if I got audited, I would deal with it at that point.
Right.
But however, as a CPA, part of what I'm doing and educating my clients with is how to manage the audit risk. So one of my biggest tips is to try and get things off your individual tax return and use some sort of a partnership or an S corporation to run your business through instead. Your chances of being audited for as an individual, if you're making $200,000 or more, was 2.7% for 2013. However, if you got it off onto a partnership or a S corp return, you were down to 0.42%. So that's a 6 or 7 fold difference in terms of your audit risk. So trying to manage that audit risk and understand that audit risk, anytime you can get things off your individual return is going to greatly reduce that audit. And even if you're right in an audit, they're still expensive to go through and they're a real hassle.
Yeah. Yeah, I can personally vouch for that. And most importantly, your opportunity cost of your time you spend going through an audit, especially if it's a major one.
Yeah.
We went through, I mentioned to you, we went through a major audit last year, found no wrongdoing, but it still took us 10 months of our time to dredge through a bunch of, stuff. So not fun, but,
yeah.
One of the things that I wanted to talk about is more specifically some of the tax changes, recent changes and things that are impacting real estate investors specifically. And I know there's a few things. Probably the big one that folks talk about and maybe don't quite understand is this 3.8% tax
Sure.
for essentially to pay for Obamacare. It's a Medicare tax. And like I said, most of the commentary or articles or things that I've read tend to be focused on how it'll impact an individual homeowner, which if it's their primary residence, it may not impact them. If their adjusted gross income is under $250,000, which obviously for most people in America it is, but there are a lot of real estate investors that make a lot more money than that, and they're going to potentially be impacted by this tax. Can you tell us a little bit about the tax itself and maybe try to demystify it a little bit, and then a
Sure.
little bit about how it's potentially how real estate investors can try to minimize the burden of that tax?
Yes. So there's that new 3.8% Medicare tax, which is what we're talking about. And this is a Medicare surtax on unearned income. This is in effect, your investment income. And your investment income is made up of interest, dividends, capital gains, annuities, rental income, your net rental income, not your gross, royalties, and any sort of passive activity income. And your income is your net investment income is taxable to the extent that exceeds certain thresholds. That threshold is $200,000 if you're single, or $250,000 if you're married filing joint. So let's say your adjusted gross income was $240,000 as a married couple. You had $20,000 worth of net investment income. $10,000 of that net investment income exceeds that $250,000 threshold. So you'd multiply that $10,000 excess by the 3.8% Medicare tax. In that case, you'd be taxed at around $380. Okay. So some ways to kind of get around that. What's not included is any sort of W-2 income, active trade or business, self-employment income, nor are distributions from an IRA subject to this income. However, if you're normally below that $250,000 threshold, if you're married filing joint and you take a large IRA distribution, that could push investment income up above that threshold when it wasn't normally able to be taxed. So from an investment perspective, ways to potentially get around this. And now this next part is untrue, not tried in court yet, but based on my belief of how the tax law reads, I think you can avoid this 3.8% Medicare tax on your buy and hold rental properties as a landlord if you can prove material participation. And what that is if you can prove that you spend 500 hours or more in your rental real estate business, then you are materially participating. And in order to do so, you may need to aggregate your rental activities together, because normally you have to calculate that time requirement on a per house basis. So you can make an aggregation election to aggregate all those together for the purposes of calculating that 500-hour requirement. Now, there are some pros and cons of making that aggregation election, which are a little more complex, but that is one way to do it for those who primarily focus on a real estate type business.
And that separates you between active and passive investor. Is
Correct.
That what you're trying to do there?
So really what you're doing is you're saying, I'm in the business of real estate. I don't have a W-2 income. Really, I'm primarily focusing a lot of my time in this real estate business. So with that requirement, this is no longer an investment activity. This is now a business activity.
Okay. And can the time that you spend, does it have to be just on managing, or any time you spent on your rental properties? Can it also include the time you spend acquiring properties for those entities? Because for active investors, folks that buy from wholesalers and things like that, maybe don't spend a lot of time. Those people like me that advertise, generate leads, look at a lot of leads to get one buy, we spend a lot of time on the acquisition stage. Can that all be folded into?
Yes, you can.
Yeah,
you can.
That's great.
Absolutely.
Okay. That's great. That's good to know. So one thing we should say, we talked a little bit about this, is this show is meant for educational purposes. So you should definitely talk to your accountant or tax planner instead of taking advice from Keith, and definitely from me. So I don't even have a CPA. So
we should talk to a CPA about your individual situation. Doesn't mean you shouldn't take advice from me, but consult me on a one-on-one basis just to make sure that this applies to your individual situation.
That's right. Awesome. Well, that's great. Yeah, it's kind of new territory for tax planners and for real estate investors, and it doesn't obviously just impact real estate, but it impacts. Given that our focus is real estate, that's mostly what we care about. So, what other tax laws are coming up or have changed over the past year or so that you think are things that feel like they're a little unclear as to how they're impacting investors, or investors are maybe unclear? Anything else you want to talk about?
Yeah, there's one really big one. This is the new capitalization requirements. And what capitalization is whenever you buy like a rental property or a building, and you are going to hold that property for any period of time, you need to depreciate that property over a period of time. Just because you drop $30,000 onto a rehab for a new rental property you just bought doesn't mean you get a $30,000 write-off against your taxes. Instead, those costs of the rehab are capitalized and depreciated over 27 and a half years. So the IRS issued finalized regulations as of September 19th in 2013. So they've kind of had these ongoing proposed regulations for the last 5 years, where they've been refining them a little bit each year. And so they finally issued the finalized regulations, which help clarify what the new capitalization rules are and what we should be doing. Previously, there was a lot of gray area. So what this does is it means that any amounts paid for new buildings improvements all need to be capitalized. If you're paying money for any sort of a restoration or betterment, a betterment meaning you're doing an expansion and increasing efficiency or quality, these are all things that need to be capitalized. So to kind of give some examples as to what you can write off, since they did clarify this as well, are any costs to maintain, improve, or a unit of property. Some examples would be like light bulbs, air filters, touch-up paint. These are all things for maintenance. Now, they did issue these new de minimis rules, meaning that there were not previously any rules under which you could just straight write something off. So if you were to put a microwave into your rental property, even if it only cost $125, you were supposed to capitalize and depreciate it over 5 years. Under the new de minimis rule, if you don't have a written policy, you can deduct any cost, $200 or less. If you put a written policy in prior to this year or prior to the next tax year, you can deduct up to $500 or less. Or if you're a little bit larger and you have audited financials, you can deduct $5,000 or less. So where this works in practice is maybe you're in an apartment complex and you put in that $500 written policy. You could have a $450 dishwasher you were putting into each of your units, and previously you'd have to capitalize all those. As long as the delivery and installation costs are below $500 for that new dishwasher, you could write off each of the dishwashers in the year that you installed them into your units. So that's a huge advantage right there.
Mm-hmm. Yeah.
And then on the other point, they also clarified what the betterment rules are and when something's a repair or expense. So let's say, for example, you have a roof on one of your rental properties. It was in decent condition beforehand, and then you have a hailstorm that hits your roof. That's something real common here. If that hailstorm hits a roof with 15-year shingles, if you replace that same roof with 15-year shingles, even if it costs $5,000, it can be deemed a repair because it does not somehow increase its efficiency, or it's not a betterment in any sort of way. However, if you were to replace that roof with 30-year shingles, which is better, then that would be a capitalized asset.
That's interesting. Yeah, we have. Again, not to dig too much personally into this, I told you we went through an audit, and this is really the main issues they had were what we were expensing for our rental properties. You know, in our instances, we buy a house. There's sometimes where we buy a house for $5,000 and we put 30 or 40 into it in repairs to get it rental ready. There's just very distressed houses, and so there was always a gray area between what is an actual improvement, improving it from its current state or improving it from the state that it was, you know, previously in. Because there were always things like if you don't add, if it already had central heat and AC and the system doesn't work and I put that in, how do I treat that versus a house that didn't have central heat and AC and I installed it for the first time? So those are always the gray area things that we dealt with in the past. So yeah, it sounds like they've maybe clarified that a little bit.
They have, absolutely.
Okay. Awesome.
So the general rule of thumb is any costs you incur in terms of repairs or rehab prior to the house being available for rent when you first purchase it should generally be capitalized and depreciated over 27 and a half years. However, carpet appliances and fence could be depreciated over a lesser time, such as 5 or 15 years.
Mm-hmm. And then one of the clarifying things there too is when the house essentially goes into service. If you buy a house and you rehab it, most of the expenses are going to have to be capitalized. But once it goes into service, expenses you have from that point forward are treated maybe differently.
So a house is deemed to be placed in service once it's made available for rent, meaning somebody could move into the house, maybe start marketing it, that sort of thing.
Okay. And how do you advise people to document those dates? Is it and what is in service mean there's a tenant living in it or you've started marketing it?
It means that the house is available for somebody to move into. It doesn't necessarily mean you started marketing it, but having started marketing it is a big indication of the fact that you could move into it. Because some folks start marketing their properties prior to them being finished with the rehab. Right. And so that's where it doesn't quite cross over, but it's a good indicator. Usually, the only difference from month to month on that available for rent is what month the depreciation starts. So having 1 month difference, if there's a little bit of a gray area, the IRS, I wouldn't think would beat you too much up over taking 1 more month of additional depreciation if it was really on the gray line. But having that lease to back it up, if you said the house was available for rent in March, but the lease didn't start until October, I think that's where there's a bigger gap. But if we've got only 1 or 2 months difference, I don't think anybody's going to bust your chops over that.
Right. Awesome. Well, that's good information. Talk a little bit about how folks, because we have an audience that's all over the country, how do they go about finding a good accountant and tax planner?
I think a big thing is, one, being able to sit down with folks. Hopefully they offer some sort of a free initial consultation. They're not going to charge you just to do a meet and greet. I think if they're personally a real estate investor, I think that speaks a lot to their mindset.
Yeah.
So being as a real estate investor, I have knowledge beyond simple tax preparation. So they're going to be able to get in and start talking about, well, this is what I did in my business, or these are the kind of rates I see out there. And it's a change from just simply being an employee mindset to being a business owner mindset.
Right.
So having that change, I think within itself is a big one. And then also maybe just kind of quizzing them about what they do, what other clients they have that are doing real estate. Because there are specific laws regarding real estate that somebody who doesn't do it on a regular basis is not going to be as familiar with, and they're not going to know how to take certain costs. For example, your educational expenses from like real estate investment seminars. There's a publication out there, publication 550, put out by the IRS that says educational seminars and investment seminars and meetings and clubs are non-deductible. So that goes in the face of a lot of gurus who are talking about how their fees are deductible. However, as a CPA that's used to dealing with this, I know that maybe I can't deduct it outright as an investment expense. However, if I can somehow directly relate those costs to somebody starting a business, or relating it to the acquisition of a property, or maybe you go to an investment seminar and they teach you how to rent out your properties or to buy properties, then I think you could find a way to deduct that. And it's just not a matter of if, it's a matter of when and how.
Right, right. Awesome. And do you serve clients all over the country?
I do.
You do?
I have clients. I love meeting clients, but I have a good percentage of my clients that I've never met.
Okay. Okay. Awesome. Well, we'll definitely add links below the video for folks to get a hold of you if they're interested in working with you directly. So
sure.
I know, again, we don't personally work together, but I know other folks that do. So I've heard nothing but great things. So I think if folks are looking for a tax planner or accountant, they should definitely get in touch with you. And again, we'll add links below the video for that.
Thanks, man.
Awesome. So tell us a little bit about what's coming up. It seems like just if you could draw a trend line of how much of a burden taxes are on the real estate investor, it seems like it's going in a direction year after year that is not good for real estate investors. Can you talk a little bit about just the kind of trends and what you see happening over the next few years to come?
Sure. So initially, there were laws put in place to help out real estate investors and real estate ownership in the late 70s and early 80s. And some of these rules were not indexed for inflation. Most notably, you can deduct up to $25,000 with your rental real estate losses, but that phases out between $100,000 and $150,000 worth of adjusted gross income. So that was not indexed for inflation back in the 70s. And so initially, a lot of people didn't fall into that. Now, most of those that have some sort of success do. So over time, as rental real estate and real estate in general has become more of a business focus and there are more investors getting involved, that means that Congress is going to look for more ways to tax it and get their cut of it as well. Yeah. So over time, you're seeing that we've got that 3.8% Medicare tax that's kicking in. That will affect a lot of investors, especially those that aren't prepared. And then there's still a lot of gray area as to when you are or are not in business within real estate. And the IRS has started to clarify some of those issues, but with such a gray area, it's a facts and circumstances test according to the courts, and you really have to look at individual clients. So like I said, the tax rates are expected to go up. It's starting to get heavier as the IRS, as Congress looks to tax that group more. And in the past, historically, real estate investors have not had a lot of representation or lobbyists lobbying for their tax rights within Congress, like some of the other industries have had.
Mm-hmm. And how do you see what you just said there? How do you see that changing? I mean, clearly there's a lot of big hedge funds and a lot more organized money, I'll say, in real estate investing over the past few years. Now, those interests don't necessarily represent the interest of the individual investor, but do you see there being more representation in the real estate investing industry?
I do. Actually, I've heard of at least two different groups that are trying to kind of, I don't know that unionize is the right word, but to have some sort of an association that people are voluntarily paid dues to. I think some sort of an association like that could help bring us all together and go represent our interests in Washington. but there's nothing real large that I'm aware of yet that is currently doing so.
Yeah, there have been some great associations over the years that I'm aware of, but they seem to come and go, and I don't know if that's because of amount of funding they have. I'm sure that has a big part of it, but that's interesting. Yeah.
Well, truly, most investors tend to be independent on their own anyways.
Right.
So it's not like we're licensed by some board like the American Institute of Public Accountants or Certified Financial Planners. It all flows through the same group of people, and they are forced to bind together. Investors, however, maybe through you, Mike, through Homevestors, you guys have some small groups out there, but there's nothing holding you guys together nationwide across all different investor types.
Yeah. Yeah, there's no doubt. We'll have to search out what's kind of hot right now, because these are really important topics. They're important for me and our industry, and definitely through some of my affiliations with either Homevestors or obviously FlipNerd. We plan to be a significant voice in the investor community, not just educating people and helping connect individual investors or people that invest in real estate with folks like you, Keith, but also to kind of unify the industry and have somewhat of a voice. So not that I'm necessarily looking to start my own association, because I've got enough irons in the fire, but
got my vote.
That's definitely something that we would get behind and support. So if anybody's listening to this, definitely get in touch with us and let us know what some of the top groups out there right now to represent us are. So awesome. Well, anything else happening that you want to share from a tax perspective, or any kind of parting comments? This is such an important issue. And I can tell folks, for me as a real estate investor, I didn't really understand how important it was in the first couple of years, like I do now, being more of a veteran real estate investor, to just tax planning. And we work so hard for our business and to make money, obviously. And with there being so many gray areas in the tax code, unless you're working with somebody that knows what they're doing, you're inevitably going to be giving up more of your profit to the tax man. So
yeah, so the rules are just constantly changing. There is more pending legislation out there. So just speaking with somebody who's knowledgeable of what the current state is, specifically around real estate and real estate investors, and when you have a question or you have a big situation coming up that could lead to tax, if you're looking to cash out from an IRA, or if you're looking to sell a big property or start a new business, that's when you should be talking with a CPA who can help guide you through what you should be doing, so you don't get bitten in the end.
Awesome. Well, Keith Borg with the Borg firm, thanks for joining us today. Appreciate it.
Thank you.
And again, we'll add links below the video for anybody that wants to contact you. And appreciate your time. It's great information. Taxes is, and you know this, for the average investor, it's not something fun or sexy. I know it's probably more sexy for you, but it's such a critical issue that it be done right. And it really plays a big role in your sustainability of being an investor, to be able to continue to do this and not have to give away everything you make to taxes that are unclear. So get a hold of Keith, and if you don't, make sure you find a good accountant or tax planner to help support your business. So thanks again for joining us, Keith. We'll see you around.
All right. Thank you.
Okay. Have a great day. Are you a member of FlipNerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit FlipNerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry. So get on over to FlipNerd.com.